The dollar just quietly got a downgrade, not from a ratings agency, but from reality. Other countries are dumping it, gold is replacing it as a reserve, and your record-high portfolio might already be underwater once you price it in hard assets. Today on the comment section with Thomas Paul, we're breaking down how the dollar is being devalued in slow motion, why central banks are quietly preparing for a reset, and what you should actually watch next. Here's where things get interesting. Let's start with the part nobody puts in the headline. The dollar is losing value way faster than the official inflation numbers suggest. If you measure the dollar against gold instead of a government-approved consumer basket, the picture is ugly. Over the last decades, the dollar's purchasing power versus gold has collapsed. On paper, CPI might say 2 to 3% a year, nothing to see here. But in real terms, your currency is melting. That's why stocks at all-time highs is a bit of a joke. Once you adjust the S&P 500 for gold, a big chunk of that performance disappears. One analysis shows a gap of roughly half between nominal returns and real returns in hard assets. Translation: a lot of what looks like growth is just your money running on a treadmill while the dollar slides backward. When I was 12, my parents trusted a nice man in a suit at the bank. He told them their savings were safe. A few years later, after some inflation and a couple of bad products, that safe pile was basically cut in half. No crash, no drama, just gone, silently. That's exactly how slow devaluation works, but it's even getting worse. Behind that slow bleed is a political trap that Ray Dalio and others keep pointing at. Governments have two ugly options when they're drowning in debt: raise taxes a lot or print money and let inflation quietly steal from savers. High taxes push wealth and businesses out of the country. We just watched that play out in places like the UK. Tax hikes, rich people and capital running for the exit, and still not enough revenue to fix the hole. So the more attractive option for politicians? Print. Inflate away the debt. Don't call it confiscation, call it stimulus or support. Same effect. The government's real debt burden shrinks, but your savings and salary buy less. Here's where things get interesting. In practice, that means the central bank is trapped too. It can't just jack rates up to crush inflation forever, because higher rates make government debt way more expensive to roll over. So policy slowly shifts to keep the government solvent first and hope citizens don't notice how much purchasing power they're losing. That's why, even if policy rates start coming down, real market yields can still spike. Investors demand a higher return to hold long-term government debt when they suspect inflation and currency risk, and when trillions in cheap debt are getting refinanced at much higher rates. And here's where things take a step further. This isn't just about your domestic inflation. It's about the world's trust in the dollar as the ultimate safe asset. For decades, central banks stocked up on U.S. Treasuries. Then 2022 hit. The U.S. and allies froze a huge chunk of Russia's reserves. Whatever you think about the politics, every other country watched that and went, wait, our savings account can be turned off by a foreign government? Since then, you've seen a quiet but massive shift. Countries like Poland, China, Brazil, and others have been reducing their dollar exposure and loading up on gold. Gold is now basically the second most important reserve asset, edging out many fiat currencies. Why? It can't be frozen in a New York clearing system with a political decision. But then the unbelievable thing happened. To protect themselves, some countries started building alternatives to the dollar-based system. New payment rails like CIPS and BRICS Pay are designed to bypass SWIFT and reduce dependence on the U.S. banking network. We've entered what you could call capital wars. Money itself has become a weapon. Sanctions, asset freezes, currency swaps, alternative payment systems. It's less about free markets and more about who controls the pipes. And here's where things take a step further. Once money turns into a geopolitical weapon, neutral assets look a lot more attractive. That's why central banks buying gold in record amounts is not a gold bug fantasy. It's a logical defense move. If you're worried your reserves can be blocked, you buy the thing nobody can delete. Investors are slowly waking up to this too. Dalio has been on record suggesting something like 5% to 15% of a portfolio in gold as insurance against a debt and currency spiral. Not as a YOLO bet, but as a hedge if the political and monetary system keeps eroding trust. Now, before we dive into what to actually watch next, quick note, this video was created with Fludge.io, the same system that powers this entire channel. If you're watching this and thinking, I'd love to run a YouTube channel like this, but I don't want to be on camera, this is exactly for you. Fludge does the research, the script, the thumbnail, the AI avatar, and the upload. You stay in control, you approve or tweak, and over time it learns your style. It works in any niche, finance, news, history, whatever. No camera, no editing, just consistent, high-quality videos. If that sounds interesting, check out Fludge.io after this. Here's where things get interesting. Let's talk implications and what to actually track instead of doom-scrolling headlines. First, watch what central banks do, not what they say. If they keep accumulating gold and trimming treasuries, that's your real vote of no confidence in the dollar's long-term dominance. Second, look at how your assets perform against hard benchmarks, not just up in dollars, but up versus gold or other scarce assets. That 10% gain in a stock index means less if the currency lost 8% of its purchasing power in the background. Third, keep an eye on refinancing. Governments, companies, even households that borrowed in a zero-rate world are rolling into a much more expensive world. That squeeze shows up in weaker growth, higher defaults, and more political pressure for one more round of money printing. But then he said this unbelievable thing. There's also the AI angle most people miss. As financial systems, payment networks, and even currencies move more digital, the temptation to build fully tracked, programmable money gets stronger. Some people look at things like Bitcoin and say, freedom tech. Others worry about the opposite, central bank digital currencies with perfect surveillance and control. Flip a switch, and your money is limited, taxed differently, or blocked from certain uses. In a world of capital wars, programmable money is a powerful tool. That's why a lot of basically sane investors still like dumb, boring, shiny rocks sitting in a vault or physically backed ETFs that at least claim to hold the metal, like the big gold funds out there. They're betting that, in a messy reset, those claims will be worth more than a digit in a system that someone else controls. Here's where things get interesting. If this all sounds like end of the dollar tomorrow, slow down. This is more likely a long grind than a sudden collapse. The U.S. still has huge advantages: deep capital markets, rule of law, military power, and inertia. You don't overturn that overnight. The real risk isn't a movie-style crash. It's a gradual downgrade. Less trust, more alternatives, more inflation, more financial repression. A world where the dollar is still dominant, but not unchallenged. And the average saver pays for the transition without ever getting a vote. When I was in my early 30s, I invested in something boring while everyone chased hype. It didn't double overnight, but over a decade, it quietly outperformed most of the once-in-a-lifetime plays. That's the mindset that helps in this kind of environment. Understand the game, hedge the big risks, and ignore the screaming headlines about guaranteed anything. This is not financial advice. It's information and opinion to help you think. Talk to a qualified advisor before making investment decisions, and remember, you can absolutely lose money trying to play macro hero. If you've watched this far, I want your take. Is this just another inflation cycle we'll forget in 5 years, or are we living through the slow-motion downgrade of the dollar's dominance? Drop your thoughts in the comments. I read as many as I can. And if you want more fast, skeptical breakdowns of how AI, money, and politics collide, hit subscribe, turn on notifications, and I'll see you in the next episode of the comment section with Thomas Paul.